Ladies and gentlemen, welcome back to the Capital Flows podcast. I am going to allow a moment to let people join for the live session, and I'm going to walk through the recent developments that we've had and break down how to think about the changes we're seeing in interest rates, not only on the short end, but also the long end, and how that connects to the data that we are seeing today, how inflation expectations are beginning to play out. So if you're watching this, wherever you're at, if you're on YouTube or if you are on Twitter or wherever it might be, if you can throw something in the comments section and then retweet it or reshare it wherever you are at, I would really appreciate that. That would mean a lot. And I am going to get started right now. So give me one moment and we are going to lock in. Okay. Thanks for reposting it, guys. Thank you. I appreciate it. Okay, so the place that I'm going to start is that we have been in a very unique period of time over the last 3 to 4 months. And the reason for that is because interest rates have been moving up over that period of time, specifically in the 30-year. And that falls into the larger context of since 2021, when we entered into this new regime of higher nominal growth, you have this shift where rates are at an elevated level and they're clearly not moving down with a recession risk or something like that. So when you think about this period of time, when we are in this range right here that we are in for long-term interest rates, the implication of that is that to move out of that range to the upside or to the downside, we need a significant impulse that begins to change how flows are functioning. And what we have seen is the beginning of that impulse to the upside. And what we saw today in the economic data release is initial claims basically coming in at the same number. We're 10 over the survey, but again, very, very small. No really significant changes there. But the significant change that did happen was S&P Global Manufacturing PMI came in well above expectations, which means that growth is not actually decelerating in the way that people think. And so when that takes place, when growth is greater than what people expect, bonds move down because they are primarily pricing duration risk. And the long end is primarily reflecting long-term nominal GDP expectations. If you have not gone over any of the educational primers on the Substack, you're going to want to go to that. And then for everyone who stays to the end of this stream and the end of this recording, I am going to have a special thing for all of you guys. So stay tuned for that. And it's going to break it down. It'll be really helpful, but we'll get to that at the end. So we had data come in above expectations today in the PMI. And then that began to set the stage for more downside in bonds. And what we are seeing now is just the long bond futures. Notice that on the left-hand side, we had that rally that previously took place, and it caused the spike for the NFP print. Since that time, we had the CPI, PCE, and PPI print all caused the short-term top in bonds on this chart. And then what began to take place is people realizing, wait a second, inflation risk is actually greater than recession risk right now. And all the people that got super bulled up on bonds, now they have to sell bonds and unwind their positioning and unwind their bets to readjust for the actual growth that is in the system right now. So we're back at this NFP level that the initial, scare at, originally happened. And I'll break that down a little bit more when we switch over to TradingView. The PMI chart, you can see it right here. We came in way above expectations, especially compared to the historical analogy. And when the manufacturing section is the line item that is accelerating, manufacturing typically has a higher sensitivity to interest rates. And so when you have that accelerate, it shows there's actually a lot more growth in the system, and interest rates are not even being restrictive in the truest sense. If it were, you would have equities a lot lower, and you would not have inflation swaps rising on the day. The entire imbalance that we are seeing right now is in this chart. The white is 1-year inflation swaps, which are sitting above 3%, and you have credit spreads at lows, which means that inflation risk is elevated. It's been saying that for a while, and we are now just seeing the realization of that inflation risk as you have the PCE, CPI, and PPI prints come out over the last couple weeks, above expectations. And that is the macro view I've been laying out for a while now. And when you have inflation accelerate and credit spreads fall, and on top of that, the Fed is allowing cuts to be priced in the forward curve, all of that sets up for support in equities, which is why we've seen the rally that we have seen thus far. As we move to Jackson Hole, there's a bit of a positioning change that we're seeing, and I'll cover that in a moment. But the macro regime is showing inflation risk is greater than the recession risk. And so on the day, we are having inflation swaps actually move up across the curve. 1-year inflation swaps are up, and then all the way down to 10-year inflation swaps and farther down the curve are all up on the day. The way that this connects to equities is that once long end rates begin to rise enough, they could drag on equities. We are not there yet, though. So a lot of people have a bias toward 2022 that long end rates moving up are bearish for equities. If you actually look, when long end rates are rising, a lot of times equities rally as well because long end rates are rising because growth is rising. And so it's really about when do the higher rates have more downward pressure on equities than the underlying growth impulse in the economy to the earnings function. If you haven't looked into the distinction between earnings and valuation in the S&P 500 and how that functions, you can just go on to the Substack and go to the S&P 500 primer and see the entire breakdown that I already wrote of that on the educational primer section. And all of that is at capitalflowsresearch.com. So we're still compressing in this range. In the chart, you have the MOVE index in white and the VIX in blue. These are both compressing in a range as bonds are compressing and facing headwinds and moving to the downside on a marginal basis, and equities are moving to the upside. Within this, we can always have short-term moves and positioning unwinds that shift, but the trend remains steady that we are not seeing the higher interest rates begin to drag on equities yet or a significant change. However, that risk is building right now, especially in bonds, for bonds to move lower. Bonds can move lower for a while. It really depends on the speed, because if bonds move down just slowly over the next 3 months, that doesn't necessarily have to drag on equities. And so it's really about when does the speed take place and cross-asset vol begin to rise, which is why watching vol is really important. And watching FX vol is also key, because here is just all the major FX pairs, and they're all compressing in a range for implied volatility. So when you see that moment when we set a top in equities, whenever that is, or we have more of a risk to the downside, that's when you want to be able to be more prepared, and that's going to be reflected in cross-asset volatility. The entire breakdown of how that works on a bigger picture basis, I just published a report on the Substack for that, and you can go see that at capitalflowsresearch.com. On the left-hand side, if you see in the top green primer, it says free educational primer, everything on macro and markets. That has an entire list of all the educational primers that you would ever want to read, every single book recommendation that you could ever want to have on macro. I wrote that because that is what I wish I had the first day I came into markets. Someone just says, hey, here are all your resources. Read through all of these. Start beginning to understand all these books, all these papers, all these different things, and then you'll begin to set a foundation of knowledge for how to think about the markets that we operate in. On that section on the left-hand side right here, I just published a video that breaks down the macro report I wrote, where it covers how is liquidity not just about the Fed, and it's actually global in nature, and how does that impact things like Bitcoin and equities and all of the things that we were seeing. And then obviously all the videos that I'm posting them on the Substack, but they're also on YouTube as well. You can go to Capital Flows Research on the YouTube channel and see everything there. So everything is laid out there. And before we hop off, I will go over all the charts in TradingView so that people can have a little bit clearer of a picture of what is taking place right now. All right, so here is ZT, which is the 2-year futures contract. And you will notice that here was the NFP print that pushed things higher. Since that time, we have trended down. Why? Because this NFP print way over extrapolated. Everyone thought that growth was going to collapse immediately on a single NFP print. Not happening. And look, you have UB right here, and I already noted this. UB has already retraced the entire move, which indicates that long-term nominal GDP expectations were not continuing to deteriorate. If they were, you would have UB up here at 122, not at 116. And so that is very important for the type of situation that we are in. And watching the stock bond correlation here is going to be really important. The thing that I will have is, for everyone who is watching this, if you are a free subscriber on the Substack, you don't even need to be a paid subscriber. I will be sending out a model that breaks down how exactly to map interest rate risk in things like the S&P 500 and also Bitcoin and every other major asset. When you think about interest rates, they are fundamentally the price of money. And it's not just the price of money in the US, because US interest rates do impact things. Obviously, we have the global reserve currency, but interest rates are global in nature between different countries, and they connect with FX regimes and everything else. So every single asset, interest rates are the price of money, and every asset, good, or service is priced in money. So if you are taking a view on an asset, you're not taking a view just on that asset, but also on that currency it's denominated in. That's why if you go and buy equities in another country or something like that, even if they rally 50%, if the currency goes down a commensurate amount, then you can actually make zero money, because in real terms, that position that you put on didn't actually make any money, even if the equity index went up. And so the idea is that we need to bring together all these moving parts. And so whoever is watching this, if you go to capitalflowsresearch.com, all the links are below wherever you're watching this. You guys can find them. You guys know where they are. I will be sending out, it will be either tonight or tomorrow morning, a model that breaks down the regimes for, should I be thinking about, are interest rates putting upward or downward pressure on the S&P 500 right now? And then if interest rates go up to 50 basis points, if interest rates go up 20 basis points on the long end, where is the S&P 500 going based on the current regime? And it'll map that scenario analysis for you. So again, if you're a subscriber on the Substack, you can be a free subscriber and you'll get that initial model and you'll see the breakdown of where we are right now. But if you're a subscriber on the Substack, you will be getting that. So if you look at the type of period or the type of regime that we're in, the long end, right? Just the UB contract, which is representing the long bond. This has been trending down for years now. If you are having a period of time where you're compressing in this tighter range as we are moving down in this higher term range, all it takes is a little bit of a change to push it over the edge. And what are we beginning to see right now? We're seeing that change. And so the question will be, when does this change right here begin to drag on risk assets? And, my view has been that, that's one of the reasons on a short-term basis, we're seeing Bitcoin retrace just a little bit, especially into Jackson Hole, which is one of the reasons why I went neutral, and I'm waiting to be able to get long Bitcoin again. When my strategy triggers the long, then I'll publish it on the Substack for paid subscribers. And I'll lay that out. But we're seeing a little bit of an unwind in Bitcoin and then also obviously ES. Nothing significant though. Nothing too crazy. We're still seeing the Russell up on the day. And so the overwhelming picture is that equities remain skewed to the upside on a cyclical basis. Bonds likely remain skewed to the downside. And as that type of trend begins to take place and get further realized, there is likely to be a moment when the bond market begins to drag on the equity market. We are not there yet, but understanding the signals around that will be key. And I've laid that out in the Substack and all the reports. So my view remains that inflation risk is greater than recession risk, that bonds face significant headwinds, and understanding how interest rates and bonds are impacting risk assets will be likely the differentiating factor in making trades in Bitcoin and the S&P 500 over the next 3 months, which is why I'm going to be publishing that model for everyone. So all of that, again, is laid out in the Substack. If you go to the Substack as well, all of the playbooks on macro and markets are there. So I will link this below. Let me grab the link so everyone has it. And I'm going to put this in the chat. I'm going to put this linked on Twitter and then also on YouTube. And then also here. This is the link for all of the playbooks that I've laid out. They're 100% free. You can go on the Substack and go directly to them and see how should I think about the credit cycle? How should I think about interest rates? How should I think about, there's an entire playbook on Bitcoin there. And there is an entire playbook on the S&P 500 and how to model that and how to think about macro liquidity and things like that connected to it. So that is on the Substack. And I just linked that below in the Twitter article, and then you can find it there. And then I will put it in the Substack chat as well if you have any questions. And let me put that there right now so that if you go to the Substack chat, you can see that right now. 1 second. Okay. I'm going to go over a couple quick questions and then we will wrap up. But again, for everyone that's just joining, you can go back and see the recording. I've laid out all the macro views. I will be sending out a model to everyone who is watching here today, who is a free subscriber on the Substack. So you can go to capitalflowsresearch.com and see that. The questions I will go over, let me pull them up. Okay, great question here. When moving into a major economic release, what's your thought process and what are you factoring in on the impact that a release could have on rate markets? Great question. So if you are moving into a CPI, PPI, whatever type of print there is, then you always want to understand how hedging pressures and things like that are functioning during those periods of time. What I will link below is in the educational primer section, there is an entire primer on how to think about macro catalysts. And I'm putting that in the comment section below the Twitter link for this stream. And then I'm also going to put it right here and you can see it really clearly, the link for it. Hang on. Right here. And if you just go into the educational primer section and go down to macro alpha primers on the Substack, it will lay out all of those. And these, all the macro alpha primers, all the educational primers are free. And you can always go through all of those. And that is right here. And that's just on the main page. So if you go to the main educational primer section, scroll down, macro alpha primers, go through these, and that actually explains how to think about all those things. Fundamentally, when we move into macro catalysts, unless you have a significant edge in predicting them, it is a coin flip whether you are going to make money on that. And it's a horrible trade if you're taking coin flip trades. You always want to stack the deck in your favor. And so I would just say go through those educational primers. The educational primers are free for a reason because I want to just lay everything out. And I always tell people, just go through the educational primers first and all the free material before becoming a paid subscriber so that you can understand and set a foundation for things. You don't need to become a paid subscriber right away. There's so much stuff I've laid out in the Substack that lay out the macro regime and how to think about it from an educational perspective. And then once you want to tie it all together, that's what all the paid content and reports are for. All right. Going through a couple more questions. Good one here. What would the level in long end rates be to risk assets blowing up or blowing off? So number one, let's say we have the US 10-year here. In my view, it's that it's going to go up. There is uncertainty and unknowability, or it's unknown at what level the 10-year interest rates will begin to drag on equities. It's unknowable. No one knows. No one knows that exact thing. You can model some different things in terms of mapping all the maturity distributions and credit risk. But at the end of the day, even when you do that and you map, basically what like people will do is take every single corporate bond or debt instrument that has an active market in it, or that way they just know it exists, and they'll map the credit ratings and credit risk of every single major company and when it comes due and how the interest rate risk is having an impact on that company. And then they'll say like, how is this impacting the economy and all this other stuff? And they'll connect all those things. Even when you do that, you do not know the exact level that interest rates will have a restrictive effect on equities. The more important thing is about how the curve moves in connection with that and with volatility. So if and when long-term rates rise, it is not about a certain level. It is about one, the speed that they rise, and two, at what point does the Fed have to play catch up and flatten the yield curve to begin to shift its stance? As those things take place, then you want to look at the relative momentum of bonds to stocks, and then also the correlation of that. And those in connection with cross-asset vol will begin to send you a signal. If that sounds a little complicated, just take the script of what I just said and ask ChatGPT to build you a model on it, and it's pretty straightforward. All right. Let's go. Couple more questions. One moment. Could you say again where all the macro books are? If you go onto the Substack and you go to the interest rate primer, right here, I will link this. If you just search the Substack for this interest rate primer, it's in the educational primer section. It has an entire list of all of the educational books that you want to read on interest rates. If you are starting from square one, this is where I would start. And this is a great place. All these books are great books. Global Macro Trading, The Long Goodbye, The History of Interest Rates. All of these are great books. I still reference them all the time. I still look back at them. I'll put this link in the comment section below. And then also I will put it in the stream here so that you have it. All the interest rate primers are there. All right. And if you have any questions, you can always throw them in the Substack chat or anything like that. I try to get to all of them. There's a lot more people asking questions these days, so I'm trying to get to all of them. And I always prioritize paid subscribers if I can. All right. If I pull together all of the macro views, and then I would encourage people to go look at the recording of this video. My view is that bonds are still facing headwinds and likely to move lower. Equities are facing a little bit of a position unwind into Jackson Hole. So is Bitcoin, but I'm waiting. I got neutral. I'm waiting to get long again. And there is going to be a moment where I think being long equities in Bitcoin is going to pay again. I'm just waiting for my strategy to trigger on that. When it does, I will publish it for paid subscribers and I will break that down. But for now, I still think equities are skewed to the upside on a cyclical basis. It's just about how do we manage the positioning risk in the interim. So those are the main ideas. All of the research is laid out at capitalflowsresearch.com. If you are a free subscriber there, I will be sending out a model that breaks down how sensitive are interest or equities and other assets to interest rate changes, and how exactly should you think about that. And it's like a very seamless model that if you feel like you don't know a ton about either, great place to start. So those are all the ideas. If you have any questions, you can throw them in the Substack. And with that, I will catch you guys later.